When's the last time your insurance agent called you? Not to sell you something, just to check, to ask if anything had changed, to ask if the policy you bought 5 years ago still matched the life you have now. If you can't remember, you're not alone. And the policy in that folder probably doesn't look like the policy you thought you were paying for. I'm Micah Brown. I'm insurance licensed in Michigan. Today I'm going to walk through what an annual policy review actually covers, the four categories, the trigger events, and the version of the review I run with pre-retirees and the version I run with business owners. Different conversations, same hour. Why don't agents do reviews then? Because the annual review is part of the job that doesn't generate a commission. I said it. That's the honest answer. The sale generated the commission. The review just keeps the policy honest. There's no new product to write, and most of the time, there's nothing to sell at all. So the agent moves on to the next sale. Years pass, your house appreciates, your business grows, your kid ages off. Your beneficiary still says you're X. The policy keeps quietly drifting away from the life it was supposed to protect. The review is the part that matters. It's also the part most agents skip. So what's an annual review cover anyways? Well, it covers four categories in about an hour, once a year. One, it's going to cover your beneficiary audit. Two, it's going to cover your coverage drift. Three, we're going to go over your premium drift and in-force illustrations. And four, we're going to go over life events. Some years, the answer in every category, nothing changed. That's a clean year. Most years, something changed in at least one category, and that's the thing the review catches before it becomes a problem. So what's a beneficiary audit? Well, we're going to pull every policy, and we're going to read the beneficiary on each one out loud. That's the whole exercise. It sounds basic. It catches more problems than every other category combined. The beneficiary on a life insurance policy controls who gets the money. It overrides your will. It overrides the divorce decree in most states. Whoever's listed gets a check. Full stop. The pattern I see is ex-spouses still listed years after a divorce. Parents still listed, which should now go to the new spouse. A trust name that was never funded. A child listed who is now an adult with creditors or a divorce of their own. A contingent beneficiary is also blank. Beneficiary forms get signed once and forgotten. Lives change. The forms don't update themselves. The fix takes 10 minutes. The cost of not fixing it can be measured in lawsuits. Next up is coverage drift. And coverage drift is when the policy stays the same and the life around it changes. Your business was a startup with 2 employees when you wrote the key person policy. Now you have 18, and one of them is the operations partner the business doesn't survive without. The term policy was sized for the mortgage balance of $320,000. The mortgage is down to $180,000. The term policy is still $320,000. That's fine. You're not undercovered, but the term has 8 years left, and the runway you actually need is 15. Coverage drift goes both directions. Sometimes you're underinsured. Sometimes you're paying for coverage you no longer need. Both cost real money. And both get caught in the review. Next up is premium drift and with in-force illustrations. With permanent life insurance, whole, universal, IUL does not stay static. The cash value grows or doesn't. The cost of insurance inside the policy increases as you age. The premium you're paying may not be funding the death benefit you think you're funding 10 or 20 years out. So we request in-force illustrations. That's a document. You request it from the carrier. Shows what the policy is doing now, what it's projected to do at current crediting and current cost of insurance, and what changes if any of the assumptions shift. This is not optional for permanent insurance. Policies that perform beautifully on the original illustration can be quietly underwater 15 years if the interest rates fell or the crediting environment changed. The fix is sometimes to add premium, sometimes to reduce the death benefit, sometimes to do a 1035 exchange into a stronger policy, sometimes to do nothing because the policy's fine. You don't know which until you pull the illustration. If your only touch point with your permanent policy is the annual premium notice, funding is on autopilot. That's not planning, that's hoping. The last category is a life event. You have marriage, divorce, new child, adult child, aging parent, new job, lost job, inheritance, home purchase, home sale, business sale, health issues, move out of the state. Each one changes the insurance math. Sometimes it changes who needs to be covered. Sometimes it changes how much. Sometimes it changes the type of policy that fits. The review surfaces the life event. The conversation decides whether the policy needs to move. A move out of Michigan, by the way, is when you need an agent license in the new state. That's a different conversation, but it's one to have before the move, not after. So what's a review look like for a pre-retiree with timing windows that are close? So for pre-retirees, late 50s, early 60s, the annual review carries extra weight because some windows close. Insurability is pretty important. The healthiest version of you is usually right now. Health changes after 62, 65, 68. Take coverage off the table or move the rates up. If you're undercovered and you have the health to fix it, the review is a place to find that out. Term conversion. So most term policies have a conversion window. The right to convert to a permanent policy without a new medical exam. That window has an age cap. If you're inside that window and the health is right, conversion is sometimes a play. If you're outside the window, or about to be, that's a use it or lose it conversation. We're going to talk about long-term care planning here too. That's the age when long-term care underwriting starts getting hard, is usually around the mid-60s. If LTC is part of the plan, the review is where you decide if you're acting now or accepting the risk. And last is Medicare timing. If you or your spouse are approaching 65, the Medicare timing decisions stack inside a narrow window. That's not the annual review's main job, but it's the right time to flag it. What's a business owner review look like then? For business owners, the annual review is different. We're going to go over key person coverage. If a key person that produces $1 million in EBITDA and the business carries a $500,000 key person policy, the coverage is sized for a smaller version of the company. Growing companies outgrow their key person coverage in 2 or 3 years. We're also going to touch on your buy-sell. Was the buy-sell agreement sized when the agreement was drafted, or is it up to date? Probably because the business has appreciated and the funding hasn't kept pace. The gap is what the surviving partner has to absorb when the triggering event happens. We're going to look at group health and disability plans because premiums change, plan designs change, network access for employees may have shifted too. A plan that was right 2 years ago may have been a better option now. Executive bonus plans with Section 162 rights. Participating executives' compensation grew. The funding may need to grow with it. Your own owner's personal coverage. The business is now most of the family's balance sheet. The personal life and disability coverage may have been built around a smaller picture. Business owner reviews tend to surface bigger gaps than personal reviews, not because business owners are negligent, because the business is growing faster than the policy paperwork. So, the 1 hour review I actually run. Same hour for everyone, different questions inside it. I'm going to pull every policy, personal and business, bring the pages or the policy summaries. I'm going to read the beneficiaries out loud and watch the surprised faces when I read the next. Compare current coverage to current life. Home value, business value, mortgage balance, income, dependents, and health. I'm going to request in-force illustrations on any permanent policy and look at the funding versus the assumption. Walk through the last 12 months, see if anything's changed. Marriage, divorce, kids, parents, business, health, a move. Then write down the gaps and add the actions. Coverage to add, coverage to reduce, beneficiaries to update, conversions to consider, illustrations to request from the carriers. And then I'm going to schedule next year's review before we leave. Once a year, 1 hour, cheaper than the gap. Truth early is cheaper than stress late. The annual review is where the truth shows up early, before the beneficiary fight, before the underinsured claim, before the term policy expires unconverted, before the buy-sell gap closes a business. I built a free annual policy review checklist, 4 categories, the questions I ask in each one, the triggers that force action, the list you hand to whoever runs the review next year, including yourself. DM me the word review on Instagram and I'll send it over.